All right, Accounting 2 kiddos, welcome to Chapter 4, Section 1, where we are going to start preparing our financial information for year-end year-end reporting. This is going to be a nice review for us. Remember, we did this not very long ago at the end of our Accounting 1 book. However, what's different again is, remember, we're doing departmentalized business. So there will be a few adjustments that get made on our income or on our financial statements, as well as our other year-end information. So there'll be a few differences, but a lot of it's going to be a good review for you. So, as some friendly reminders, remember that financial statements are there to summarize the financial information for our business. And then, of course, these statements are then used to analyze and evaluate where we are at as a business, looking at not only our financial position, but also are we working toward the goals that we have set? Are we making progress toward those goals, etc.? The managers of a business, of course, use the statements to make financial decisions for future operations. So can we afford to take on more debt? Can we afford to make more asset purchases, etc.? And then, of course, they also have to prepare certain tax reports that are required by the SEC, or the Securities and Exchange Commission. Remember that our business is organized as a corporation. So when you organize as a corporation, there are certain regulations and reports that you have to create and send to the government. Now, they just want to remind us about what a fiscal period is. The period for which financial statements are prepared depends, of course, on the needs of the business. So you can have anything from a 1 month to a 3 month to a 6 month to a 1 year. Of course, for tax purposes, all businesses prepare financial statements at the end of the year, so that's going to be the same regardless. Remember that we call a fiscal period the length of time for which a business summarizes its financial information. And then if it's going to be 12 consecutive months, we call that a fiscal year. Now, before financial statements can be prepared, just as a reminder that businesses need to make sure that all account balances are up to date and accurate. So what that means is that we need to make sure that all transactions have been journalized, all journals have been posted, all 5 of our journals, and perform any bank reconciliations that we might have from our bank statements. And before we go ahead and do our adjusting entries and start preparing our year-end information, we also need to determine the accuracy of our customer and vendor accounts. So remember that the total of the accounts receivable and the accounts payable subsidiary ledgers should equal their amounts in the controlling accounts of the general ledger. So obviously the accounts receivable ledger should equal accounts receivable, and accounts payable ledger should equal accounts payable in our general ledgers. So they just want to remind us that we should do a schedule for both accounts receivable and accounts payable. So remember that when we're talking about accounts receivable, what we're doing is we're listing all of our customer accounts, account balances, and the total amount due from all of our customers. So remember that accounts receivable are people that owe us money. So you can see all of them listed here. And then the total here, $23,515 and 27 cents. That is the total that should appear in our accounts receivable account in the general ledger. And then, of course, we would do the same thing for a schedule of accounts payable. Accounts payable, remember, are people that we owe money to. We refer to them as vendors. So it lists all of our vendor account names, account balances, and then the total amount due to them. Now, at this point, all transactions have been journalized, everything's been posted, we've done reconciliations, and we've made sure that our vendor and customer accounts are accurate. At this point, we begin making financial statements by making a list of all of our general accounts. Remember that we call that a trial balance. Essentially what it is it's an equality of the debits and credits in our general ledger. Remember that we list all accounts on a trial balance, including those that have a zero balance, because they may, once we do adjustments, have a balance at the end of that. So as I just alluded to, we will be doing adjusting entries. Of course, those are the journal entries that get recorded to update general ledger accounts at the end of a fiscal period. We do a trial balance before and after that happens. So we do one before called the unadjusted trial balance, and then after we've completed that, we'll have an adjusted trial balance. So this is what the unadjusted trial balance looks like. They have taken out a few extra things here just to save on space. But you can see we start right up with cash and we work our way all the way down to our federal income tax expense. They should total, this one is $1 million, over $1 million. So they should equal by the time that we're done. At the next step then, our preparation is to collect the information required to bring certain accounts up to date. So these are the following adjusting entries that we'll be doing. An estimate for the uncollectible accounts expense, the ending merchandise inventory for grills and furniture, there's a department, information, supplies, prepaid insurance, and then some depreciation. So I'm just going to walk through these again. These should be relatively familiar since we did do them not very long ago. Our first one is for uncollectible accounts. So the adjustment information that was given to us was that the current balance and the allowance for uncollectible accounts is the $9,500 or $95.69 credit. So you can see that right here. An adjusting entry then, of course, of $2,142, or I can't even talk today, $2,114.92 is the adjusting entry amount. The reason that is it says as of December 31st, our estimate for uncollectible accounts expense is $2,210.61. So that's what we need our balance to be. So the difference between those two numbers, the $2,210.61 and the $95.69, that's the adjustment of $2,114. So again, remember that it's an allowance, or uncollectible accounts expense gets the debit and the allowance for uncollectible accounts gets the credit. Our second one is for merchandise inventory. Our adjustment information as of December 31st says that our ending inventory for grills was $89,349.72, and you can see the ending amount for furniture. In order to bring this up to date, the balance of our merchandise inventory account has to be updated or increased by $3,210 because our ending inventory was less than the beginning inventory. As you can see here, it tells us our beginning inventory was this, ending inventory was that. So the difference between those two, the $3,201, is the amount that's going to happen here. Similarly, the $3,816.53 credit for the balance of merchandise inventory, which they don't give us the beginning information, but you get the gist of what happens. There may be a point though, and I just want to point this out, that if the beginning inventory is greater than the ending inventory, then what happens here is income summary is debited and merchandise inventory is credited. Because remember that merchandise inventory is an asset. So what's happening here is we're increasing that asset with a debit. If it happened where it went down, we would need to decrease it with a credit. An income summary, remember, doesn't have a normal balance, so it can be used either way. Okay, there we go. Fancy things. Next out is our supplies one. We've done supplies adjustments so many times that I'm hopeful that you remember how to do those. It says that the adjustment information at the end of the month says that supplies on hand was $2,430. So you can see we started at the balance on our unadjusted balance says it's $7,610. So the difference between those two numbers, that $180.87, that is the amount. Supplies expense gets the debit, supplies gets the credit. That's the exact same thing that happens for prepaid insurance. Again, we've done that adjustment so many times that I hope that you remember how to do that one. Insurance expense gets the debit, prepaid insurance gets the credit. The last one that we're going to do here is our adjustment information for our plant assets. Remember that plant assets are assets that are going to be held for a number of years by our business, and that every year that we hold it, a portion of the plant assets cost gets transferred to an expense account. That's our depreciation. Remember that the amount of depreciation is always going to be an estimate, and we've done different ways. We've done the straight line method, we've done declining balance, we've done double declining balance. But regardless of that, when they give you that information that the depreciation expense for office is 7,320 and the store equipment is 8,370, that is actually the amount that you put here for your adjustment information. That is the one that's a little bit different. Remember that depreciation expense get the debit, and then the accumulated depreciation, which is the contra account, gets the credit. Um, so that is a little bit different. You don't have to do any math when you're doing the depreciation expense adjustments. So after we have done our adjusting entries, now what we should have is an adjusted trial balance, which is a trial balance that gets done after adjusting entries. I just want to point out that the federal income tax expense will still be blank at this point because that one is one that doesn't get done until later on. So this is the last adjustment that we do. Of course, there are different tax rates for different income levels. The taxable income that we have falls into what's called a tax bracket. And then the tax rate associated with that tax bracket is called our marginal tax rate. So let's look at what that happens to be. So here you can see if you fall with taxable income in between 75,000 and 100,000, then this is your marginal tax rate. So what happens is you take this amount, and then we take plus the 34% that's over 75,000. So this is the example of how to calculate your taxable income. We're actually going to do this in the work together, so I'm not going to spend too much time, but it does give you an example if you need to reference back to that. And then the thing that we always need to remember is that corporations are required to make quarterly federal income tax payments. So as we go, we're actually already paying some of this. What happens at the end of the year is that we need to know whether or not we make an adjustment because everything is based on an estimated net income. We don't know if we're actually going to make that amount. So once we've figured out that we actually owe $16,322.38, you can see how much we've paid into it and that we needed to make an adjustment of a debit of $2,322.38 to actually get to the $16,000 that we owe. And that's the adjustment for federal income tax. Federal income tax expense gets the debit, and then, of course, federal income tax payable gets the credit. We haven't actually paid that yet. We will eventually after the quarter ends. So once our adjusted trial balance is finished, meaning that we have federal income tax amounts in, both at the payable and at the federal income tax expense amount, once that's in there, then what we can do is complete our trial balance, total proven rule, and then we are ready to start making our financial statements, which we'll be doing in the next lessons. The thing that we've always used beforehand is a worksheet. Remember, that's just the column or accounting form that's used to update our general ledger information for preparing financial statements. Most of the time now what happens is companies use a computerized accounting system. If they don't, however, a worksheet's still going to be the most effective tool to try to get all of that information in one place. So with that being said, we'll head over, we'll do our 4-1 work together, and then don't forget about your terms and questions, and your application we'll be working on tomorrow.